Now, you may recall that when we first started this section on subpart F and section 1248, we said that subpart F really operates for the life of, let's say, for the term of existence of the CFC. And 1248 applies only on its termination. Now, that's perhaps overstating it a little bit by saying termination, because you could, of course, sell less than all of the shares of the CFC. You could sell, just a certain percentage and retain some amount. But in most cases, let's say the full company is sold, or there's a complete liquidation of the company, so that there's a termination. So that's maybe your most normal situation. And we said that if we look at, what is the mentality of Congress? Congress specifically doesn't want to let any income that is, good business income that's been earned and deferred within a foreign company, doesn't want to let that income leave U.S. taxing jurisdiction without being treated as ordinary income, ultimately to the U.S. shareholder. The U.S. shareholder should not be able to have normal day-to-day earnings in a foreign corporation and then sell those shares and get capital gain treatment. That's a mental problem that Congress cannot allow. So 1248 is solely for that. Prevent ordinary income from being treated as capital gain when the CFC is sold. Now, in our discussion, we'll, I think, take the simple approach of saying that the CFC, that you have a CFC, the U.S. shareholder sells it, and you have this recharacterization of gain from capital to ordinary by being treated as a dividend. But the specific rules get a bit more complicated. We won't go into details, but just understand that even though a company might not be a CFC today, the way the rules work, if it was a CFC previously, and you owned the company, over 10% or more of the company at the time at the time it was a CFC, then these look back, and you've got to make some calculations to figure out, well, gee, what's my share, how much earnings did I have during that period? It gets a bit messy, but understand that it's broader than just the general usual situation that we're going to talk about here. One of the biggest points which I want to reiterate here, I know I've said it before, but just to repeat, under subpart F, under 954 and the definition of subpart F income in 952, we're looking at specific defined categories of income, tax haven income, things you shouldn't be doing, and therefore there's current taxation, no matter what. The investment in U.S. property rules and 1248, on the other hand, are looking not at the current situation at defined categories of income. They are looking at the earnings that were successfully earned within a foreign corporation and that were not these tax haven types of income. So there's a different focus between the 954 definitions, the categories there, and the investment in U.S. property and 1248 rules. There's a different focus, very different. As you might imagine, because the subpart F currently taxed items have already been taxed to the U.S. shareholder, well, they don't need to be covered in the 956 investment in U.S. property and 1248 rules. Because, in effect, 959, the previously taxed income rules, remember, gave us ordering so that when there is an actual distribution, it first comes out of what's been taxed before. So we're only talking about what has not been taxed to the U.S. shareholder already under the 954 rules. Here, it's everything that's left where we have had the benefit of deferral for 1, 2, 3, 10, 20 years, whatever it is. Now, this is a very interesting area. Is 1248 a benefit or a detriment? And it really depends on your particular situation. You know, if we have a corporate shareholder selling shares of a foreign corporation, well, remember that if capital gain is transformed into a dividend carries a 902 deemed paid credit. And a 902 deemed paid credit, especially if it's a medium or high tax country, means that we're going to end up with very little tax on the sale of those shares, or at least to the extent of the dividend portion. If we have additional amounts, in other words, let's look at the mechanics for a moment to make sure that we're all speaking the same language. If we have a U.S. shareholder and it owns a CFC, and let's say that the earnings, the E&P down here, let's assume there's been no previous subpart F income inclusions. If the E&P down here, let's say, is 1,000, and we have a buyer out here, and the buyer is going to pay a price which gives a total gain of, let's say, 1,500. Okay, of that 1,500, 1,000 will be treated as a dividend to the U.S. shareholder, and the additional 500 will be a long-term capital gain, assuming the holding period test has been met. Now, the point that I was making is that a dividend carries, again, a 902 deemed paid foreign tax credit. So if there is a reasonable amount of tax that has been paid down at this CFC level, then there will be very little tax on this 1,000, maybe no tax. Or if the tax down here is high enough, it may generate credits that can be used against other foreign source income of the shareholder. On the other hand, a long-term capital gain does not carry any deemed paid foreign tax credits. It's just taxable to a corporate shareholder at 35%. So we have to look back and say, well, okay, there's a number of factors. What deemed paid credit is there? What is the tax situation or condition of the shareholder? Let's say, for example, the shareholder has a lot of capital loss carryovers. And let's assume that there's very little foreign taxes at this level. So there's very little deemed paid credit. Well, in that kind of situation, there'd be a full 35% tax on the dividend portion. Very little deemed paid credit. And let's assume also he doesn't have an excess foreign tax credits or carryover. If, because of the dividend characterization, he cannot use his capital loss carryovers to reduce the tax on the dividend. He can only do that to the extent there's gain that is in excess of the earnings down here. So whether it's an individual, whether it is a corporation that's making the sale, you've got to look at all the factors, in a sense, before you can say, is there a benefit or a detriment? 1248 in some situations can be highly, highly beneficial, much better than if it did not exist. This slide gives, you can read it at your leisure, gives a couple of situations where it might be better or worse for an individual. Remember also, just one other thought in terms of that dividend versus long-term capital gain. What's the source normally of a dividend from a foreign company? Is it U.S. source or foreign source? Yeah, normally foreign source. What about long-term capital gain on sale of shares? Is it U.S. source or foreign source? The general rule is U.S. source, because the general rule is you look to the residence of the person who earns the income. There is a special rule for sale of shares if there's a 10% tax and if there was an active business and so on. But the general rule is U.S. source. So if somebody has excess foreign tax credits, in the right basket and so on, it makes a very big difference because of the source issue.